Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on out-of-the-money options contracts. Again, if you're not familiar with options, make sure to take our options course on our website at bullishbears.com. You can find the link below. So with out-of-the-money options contracts, there's also two other concepts, right? There's also in the money and at the money. Again, I'm not going to go into much detail with in the money or at the money because this is going to be specifically on out of the money options contracts. So I'm going to explain to you what out of the money options contracts are, and then I'm going to go and show you where to find them within an actual options chain. Before I begin, I kind of like, and you'll see in most of my videos, I really kind of like to drill down with options and really take each part of an options contract and kind of drill it down, kind of separate it, kind of drill down and explain what that concept is. And then I kind of slowly like to walk you into the bigger overall concept of an options contract, because then once you understand how each of the moving parts work, then you can choose an option strategy that works best for you. But again, we highly encourage you, if you're new to options, don't just rush. Take the time it deserves. Invest into your education. That's where, again, we put our options course out there for you to really kind of help you to get started. And then we kind of walk you through the steps until where options start to make sense, and then we walk you into the bigger strategies to kind of help put the bigger picture overall together. So make sure to take our course if you haven't yet. So out of the options, or actually out of the money options, right, are strike prices that are higher than the current price of a stock if you're looking on the call side, right? If you're looking at the put side, it's a strike price that is below the stock price. So again, if you're looking at a call side, you're looking for any strike prices that are above the stock price, and for the put side, it's anything that is below. So any of the strike prices that are below the strike price. So those would be out of the money strike prices, right? Now remember, options are decaying assets. So, time is not in your favor. So when you're purchasing an out of the money options contract, they lose value quicker due to time decay, because again, time is not on your side. And if an option expires and it's not in the money, then it's worthless. So it expires worthless if it's out of the money at expiration. So I'll give you an example here. If a stock is at, let's say, $50, then any call option above $50 is considered out of the money. Now, if you're looking at the put side, if you purchase any strike price below $50, that would be considered out of the money. Now, it's not worth exercising any contract if it's not in the money. So if you're not in the money at expiration and you're still out of the money, it's pointless to exercise that options contract. So let's take a look at an options chain, and I'll show you where you can find out of the money strike prices, right? So you'll see here, Twitter, I just have a random stock pulled up over here. If you go up to trade, I'm showing you guys the Thinkorswim platform. You will see right up here an options chain, and you will see on the left side are the calls. On the right side, you will see the puts. You will see these shaded areas, kind of the purplish areas right over here. These are the in the money strike prices. The black areas that you see over here and over here, those are out of the money options contracts. You will see the in the money contracts are they're higher priced than the out of the money contracts, right? You'll see the prices over here are higher than the out of the money. It's because you'll see the probabilities of the stock being in the money at expiration are higher, so they are higher price, and you will see the probability of it being in the money at expiration are lower the more you go out of the money. So when you are purchasing out of the money options contracts, the odds are less likely to move in your favor, and hence why you will see the options contracts are cheaper. So in the money contracts are higher because the odds are more in your favor, like you'll see over here, and out of the money contracts are cheaper because their odds are less likely in your favor. And that's why we tell people it's very risky to just go and buy straight calls and straight puts, or even selling straight calls and straight puts. So selling or buying naked can be very risky. Again, we just walk you through the strategies of the overall concept of buying calls and puts and selling calls and puts, and then show you how to bring these strategies together and trading other strategies like spreads. But again, those are all other videos that you can take in our course. But this video here is just specifically to go over out of the money options contracts and where you can find them on an options chain, and why, again, the odds are not in your favor, and hence why the pricing is less on buying out of the money options contracts.